I'm Atul Sharma, and it's my pleasure to welcome you toward the last panel. And we always save the best for the last. So my panel is going to walk in here, and trust me, these are the guys who have the money. So if nobody cut any checks this morning, please make sure you come to them. They are really coming here with their checkbooks open. With that said, let me welcome my panel. Please come on. So we have a great set of panel here, and literally, I would say, covering the entire life cycle, all the way from seed to the full life cycle. And what's interesting is the world has kind of changed in the last couple of months. I think there was a lot of free money floating in the market in 2015. The whole commodities burst happened. There was sort of pressure in global markets, and January and February was a pretty interesting time. So we have this panel, which is literally, I would say, handpicked from different sectors, different focus. And let me just quickly introduce them. So we have Neeraj on my left-hand side. And Neeraj is actually Managing Director of Servin Ventures. Servin is a seed stage VC company, and Neeraj has been a member of executive committee at Putney. He has very rich operational background, plus VC background. And what's interesting is Neeraj is also a Kaufman Fellow. So as you all know that Kaufman is very active in whole space of entrepreneurship and how to generate entrepreneurship. So that's Neeraj Gupta. We have Umesh Padwal. Umesh is a venture partner at Thomvest Ventures. And prior to Thomvest, Umesh was a partner with Bessemer Ventures. And Umesh has seen it from all the sides. So he has been a successful entrepreneur. He has been an investor. He has been a CEO of a public company, brings a very rich experience, and he serves on the board of Palo Alto Medical Foundation as well as Sutter Medical. Then we have Rajiv Tayal, and Rajiv leads the US Science and Technology Forum, and he plays a critical role on the whole Indo-US corridor. So things related to India and US, where the funding is happening, what kind of programs are happening, what are the governments doing to support that, all those answers are with Rajiv. And finally, we have Nagraj Kashyap. Nagraj is the global head of venture capital at Microsoft. In fact, Nagraj also led the whole Qualcomm Ventures. He recently moved from Qualcomm to Microsoft. And Nagraj brings rich 20+ years of experience in all aspects of venture capital. In fact, Nagraj and his team oversaw almost $1 billion of invested capital in more than 140 companies. And he grew a team of 3 to all the way to like 25 professionals in this space. So with that, please give my panel a big hand and appreciate the discussion here. So with that, let's move on. And what I would like is really to get your perspective on something which is very important for this audience. And maybe, Neeraj, we can start from you. What are the latest investment trends? What are the latest funding trends? There was this sort of dislocation in the market in January and February. And I've heard that funding is becoming increasingly difficult in these days. So what's your view as to what's happening in the market? What are some of the key trends? And was January and February, was it a glitch, or was it a structural shift and funding is not as easy as it was in the last few years?
Yeah, I work for an institutional seed stage fund, so my perspectives may be a little bit more kind of early stage oriented. I guess at a macro level, the way I see it is we've sort of got a situation, think of it as an accordion, where we've got a lot of early stage investing that's happening. There's a fair bit of late stage investing that's taken a lot of capital in the market. And there's a bit of a crunch at the Series A, Series B level. And I'm sure a lot of entrepreneurs that are going through fundraising probably experience that. It's easier to raise seed funds, seed capital from seed funds. There's a proliferation of seed funds that's happened for a variety of reasons. Obviously, one being that it's easy to start new companies. It takes less capital in the early stages to start companies. And second, there's a lot of partners from venture firms or entrepreneurs who've made some money who've gone into creating seed stage funds. So it's relatively easy. As of last count, there's probably about 300 institutional funds that have been raised, less than 100 million in size. About half of them are less than $25 million in size. So getting that early money has been quite easy. On the other hand, if you think about sort of the larger market, interest rates being low, the venture capital industry in general since 2006 has delivered a greater than 4% better returns than the PE industry. It's an industry that's delivered between 10% and 28% IRR since 2004. So if you look at vintage 2004 through 11, it's really quite good results. So when you think about that from the sort of the LP perspective and sort of the focus from the endowments and the pension funds who are putting money in venture capital, what you're seeing is there's significant amounts of capital available. And that capital is driven very, very high valuations at the top end of the spectrum, where late-stage companies, as you see, are getting a lot of money. Over 100 unicorns, 14 decacorns with greater than $10 billion in value. So I think, and to the point that Atul raised is there's some dislocation that's happening because the IPO markets obviously are not valuing tech companies at a significant more premium than other companies. There's only a 10% premium in tech in public markets than the overall S&P. So if you think about it in sort of that context, you're going to see some valuations coming down at the late stage. We generally play at the very, very early stage. The early stage valuations seem to be tending to sort of generally remain stable. And the companies that are coming out of the sort of the seed trough into Series A and are able to raise Series A, what I'm hearing from my friends at traditional venture firms that are doing Series A, B investing, they are still struggling. The valuations are still holding pretty steady. That's kind of my general view. I'm sure there's other perspectives.
Yeah, there's definitely a dislocation in the market. If you look at the last 6-7 years, interest rates were low around the world. The geographies were doing well. US economy was doing well. China was clipping at a nice rate. India was doing well. Overall, the global economy was very healthy. And that caused the growth in public companies, private companies, consumers were spending. So it's a very healthy economy, which drove a lot of people to raise cash. When the interest rate was low, the VCs were raising cash if they had good exits. The corporates were minting money. Because of that, there are 3 or 4 trends that started happening, which some of them were unique. One is the proliferation of angels. If you look at 20 years back, there were not too many angels which existed. But with Facebook and Google IPOs, and a lot of individuals started investing. So a lot of capital came through angels for seed stage or before. Second was the VCs raised a lot of money because of the success in the IPO market. The third category which came out is private equity suddenly started coming into investing in private companies. Typically it was public investors like KKR, Goldman Sachs. These guys started investing in late rounds because they started seeing the returns in private equity were sometimes more than the public markets. And then incubators came in, accelerators came in. So very, very nice, rich environment. But because there was too much cash, too much got overinvested in companies, and you started valuations which completely blew out of proportions compared to where stage the companies were. And in SaaS, for example, 15 times revenue was the multiple, which is unheard of. All that happened and caused 140, the billion-dollar plus unicorns to come in. But I think structurally, the market's changed. I think normalcy is happening. So growth has slowed down. And as soon as growth slows down, the companies which are really doing well, like Uber or Airbnb or Slack, they're able to raise money, even hundreds of millions of dollars at higher valuation than the previous rounds. Then the companies which are small are not able to raise money at all because the sentiments have changed, the growth is not happening. So you're starting to see many private companies closing down doors. If you've not heard, meaning there were about 30 companies which closed down in this area in the last 4 weeks. But in the middle, where companies don't have a great growth but are structurally still okay and good businesses, the valuations have dropped. For example, there was a company which is Hotshot Bromium, which in the last round had to take 50% valuation cut to raise their rounds. So I think economy is definitely changed. And my prediction, like a lot of people have made the prediction, is I think the $140 billion plus valuations, they're going to be less than 20 companies when they go public they're going to keep those valuations. So definitely sentiments have become to normalcy. I think this is the way it should be, rather than irrational exuberance.
So we at Microsoft Ventures invest in the early stage, Series A and beyond, so sort of following Neeraj in terms of the seed stage. So from my perspective, on the early stage, I won't talk too much about the late stage. I think it's been covered well. We do see fundings happening, and I think the way we are seeing fundings happening in the Series A and Series B stage is that you have sort of two classes of entrepreneurs that we are seeing getting funded reasonably well. One is the sort of the successful serial entrepreneur who's still, he or she is still getting funded with the PowerPoint. We just committed to basically a successful entrepreneur along with a couple of tier 1 funds, essentially given the track record and the big market they were going after. The second category, sort of more first-time entrepreneurs, essentially what's happening there is you have to do more with less money. So before you get to the VCs, you may have to show more progress. And would that actually can translate to revenue. So we are seeing actually solid revenue companies. When I say solid, you're reaching a couple of million, 1 to 2 million in ARR at the Series A and above that are then getting funded. So it is harder, I think, to get funded if you have almost no metrics and if you're a first-time entrepreneur. At least that's been the bifurcation we have seen. But if you have reasonable metrics and you have a large market that you're showing good progress in, fundings are still happening. So I think even though I've been there for just 3 months, I think we've seen a number of fundings even since I've been at Microsoft. So I don't think it's all doom and gloom. There is some normalcy, as Umesh said. There's a return to probably how it should be for a period of time. Personally, of course, I'm getting a little bit more time to evaluate. I don't have to jump on a term sheet in 1 week, so that's a sort of nice breathing room. And I think from an entrepreneur perspective also, it's nice to be able to prioritize. Too much money always results in lack of prioritization, which means some bad decisions get made just because money is easily available. So I think all in all, it's definitely not doom and gloom, not as good as 2016, and I think it's structural. I agree with many of the other comments there.
Thanks, Nagaraj. So seems like normalcy is returning, and I don't think there is anything bad with that. So maybe what, Nagaraj, we would appreciate your comments is, now that we have talked about the normalcy and so on, what's your view about, and again, this is going to be a sector or a space-specific question, but then if you could start back from you, what kind of ideas are being funded? What's hot and what's not hot these days, specifically from a sector perspective?
Somewhat the perspective I generally take is I don't try to make judgments on what's hot or not, although I will try to answer the question. Primarily because we as VCs can develop lots of theses, but I guess my personal thesis is entrepreneurs don't follow VC thesis, they follow the problem. So if there's a problem, they go try to solve it. And then that leads to a lot of opportunistic answers to big markets. Having said that, one of the secular trends clearly is the movement to the cloud, clearly a generational opportunity for almost everybody in the room here. We at Microsoft obviously participating through Azure, but many other different respects. So I think companies that are giving structural advantages to enterprises to move from on-premise to cloud, I think are getting funded. It's an area that we are definitely looking at. And I think that is not an area that will go away anytime soon, because it's really very, very early days in the movement to the cloud. It's just starting. As you can see, when the results come out for any of the big cloud providers, that's sort of the big focus there. So I think it's very early days in that market. I'm not going to say it's hot, but clearly good ideas in that market continue to get funded.
Thanks. And I'll come back to Umesh, you and Neeraj in a second, but Rajiv, I know you sort of operate in a slightly different space, the whole corridor between India and US. A lot of that stuff is through grants, a lot of that is through the relationships between the governments. How are you sensing that space? Is there more activity in that space, or the activity is decreasing? How are the governments kind of working? But give us some sense of what's the activity in that space.
Yeah, so you're right, Atul. Actually, I am a little slightly different constituent of the overall ecosystem, that in the sense that I belong to the government side. And so I'll put up the perspective from the government side. If you see from the Indian government side, I think the things are fairly euphoric. because the current government sees startups and the entrepreneurial activities as a major driver to economic growth as well as employment generation. And there are several schemes and initiatives under the government banner. We have some Startup India kind of a general banner under which there are several schemes and initiatives to support startups, to support enterprises and entrepreneurial activities. From the US government side, I think right now the things are in a state of suspended animation, and that will remain so for the next maybe 6 months or something like that, till the elections are over and the new administration in place. And I genuinely hope that things will certainly look up going forward 2017. I represent an endowment which has been jointly created by both the governments. And again, the thing is that, we have some kind of finite source of annual revenue through which we support startups to the tune of providing grant in aid. So that's a very unique feature of the order of $400,000. The unique feature is that it's purely a grant in aid scheme and there is no payback liability as of now. Probably we'll try to change the model going forward. But as of now, there is no payback liability. And then we can certainly support kind of activities which probably will fructify or bear fruits in not immediately, but maybe in the immediate future or in the short term. So although we expect our awardees to make profit, but at the same time, we can also afford to support kind of initiatives and activities which don't bear fruit in very near-term horizon, but then they show the potential that they are going to be winners in medium to long term. Now, from my fund side, again, the situation is like, as I said, that we have finite streams of revenues. And we do have aspirations to scale them up by a few orders of magnitudes during the next 2 or 3 years. We have some kind of vision which is yet to be put in place, and then again, because it's a joint fund created by both the governments, things will probably be a little more clear after the general elections are over in the United States. So that's the situation. And in terms of something hot, any good idea which which shows us the potential, we normally support them. So unlike a conventional investor who is totally driven by the profits and the rate of return and those kind of things, we factor in the societal impact. Although we do expect people to make profits, because probably unless you have a profit model, things cannot be sustainable. So we don't see these two things as discrete. I mean, there is some kind of convergence between the two activities. And I think my view is that, governments are sluggish, but probably they are not as sensitive to wild fluctuations in fortune on quarterly basis. So from the government perspective, things look stable, and being optimistic, I think 6 months down the line, things will certainly improve.
Fantastic. Thank you so much, Rajiv. And before I move to the next question, Umesh, I'm really interested in your answer to the same question that I asked from Nagaraj, because you are focused on security and IT infrastructure. So what's hot and what's not hot?
So I'll answer the question broadly and then specifically for my fund.
Okay.
Broadly, I think cyber intelligence, cyber security is a massive problem. Used to be individuals getting hacked, then became corporations and enterprises getting hacked, then nations are hacking, now it's nuclear reactors are disarmed with software. So I think security is going to be a huge area, and it will erupt every time there's a Walmart breach or a Target breach. So security is a big area, but also areas like healthcare and IT intersection, because the healthcare cost has gone so high that trying to use latest technology to bring that cost down or provide better service to customers, that's a big one. Financial technology is getting disrupted. That's another area where companies like Lending Club and SoFi and others have disrupted the existing models of older banks. So those are some of the broad areas. At Tomvest, we are about $250 million fund, so we have to focus on a few areas. We're focused in fintech, advertisement tech, the latest programmatic advertising and others, and the area of security and infrastructure. In the area of security and infrastructure, focused on The cloud and the mobile area outside the firewalls is a rich area for hackers to get to. So trying to secure the cloud is one of the areas where lots of investments we are looking at. We are also looking at the authentication and the finance intersection of consumers trying to have multiple authentication because password and logins are an old way to do things. Can you do much better things? So security is one of the big areas of focus for me, as well as infrastructure, which is virtualization, containerization, and trying to secure the containers. So those are some of the areas broadly and for Tom West.
Thanks, Umesh. And Neeraj, since you focus on the seed side and the early stage, very early stage, I think the next question would be very applicable to you. We have talked about money, we have talked about normalcy, we have talked about the hot ideas. Now, the big question is, when two people or two entrepreneurs come to a VC with the same idea, who gets the money and who doesn't get it? So Neeraj, what's your view? If two people come to you with the same idea, what differentiates who gets the money and who doesn't?
Yeah, that's a good question. Listen, I think what happens is there's trends that take place, and within days and months, you'll have lots and lots of business plans that look quite similar, or they're generally in the same space. So, areas that were discussed already by Umesh, but, add to that AI, big data, as you know, the last few years has been a big area. So what tends to happen is you'll see a lot of copycat sort of plans or similar plans begin to show up. And what you're looking for is really authenticity, right? So you step back and you ask these entrepreneurs, what's your life story? What gives you the foundation to be successful in the plan that you're putting in place, right? So what capabilities you have, your team has, and what's the technology moat or a market moat that you're going to be able to build with the plan that you're bringing to us, right? So generally what I'm trying to find is there a life story that sort of connects the dots between, where they came from, where they want to go? Is this business sort of something that fits within their life story, right? If you come to me and sort of talk about an AI play, but you've really not spent a lot of time in that space, and you're not a computer scientist by profession with deep expertise coming out of one of the labs, it's unlikely you're going to succeed, right? So that's sort of what you're looking for, is authenticity.
Fantastic. So let's say the entrepreneur comes to you and gets some money, and so the next question, and maybe Nagaraj, I can come to you for that. Your team has funded good 1 billion, 140 plus companies. How do you differentiate? I mean, when you see how entrepreneurs spend the money, we have seen times where if you drive on 101, you will see a lot of billboards with a lot of advertisements, and the space there is very expensive. But what's a good use of money for an entrepreneur? Should they be focused on product marketing or operations? Give them some advice that, once you have procured the money, what should be their focus? How should they be intelligently using the money, especially in this normalized time period?
Okay. I'll use two examples. I think it's hard to actually generalize, but I'll take, generally speaking, we always say you have to have the best product. One of the companies we seed funded in my old job was a video conferencing play called Zoom. And the CEO came from WebEx, came from Cisco and WebEx. And essentially, he got seed funded by us and a few others. And then he hired, I think, not only the best people, but best people who could actually do the best products. And what I mean by that is he didn't go out and get open source codecs. He built everything in-house. And there was a reason. So sometimes you don't want to reinvent the wheel. But his main premise was that the quality has to be so good that the product will sell itself. And essentially, he did spend basically zero money on marketing for the first 4 years. I mean, he didn't have a marketing person in the team. And the product was so good, and even now that I've left and I'm no longer sort of part of the investment since that was done as part of Qualcomm, I meet startups and SMBs who randomly will bring up Zoom, because if you're communicating anywhere out of the US in remote parts, whether it's to India to Africa, the product just works. And to do that at scale with the video quality that Zoom is able to do is a testament to the success of the product focus that Eric and the team at Zoom laid. And now it's one of the fastest growing companies in the space, sort of beaten out many competitors. But essentially, the team spent almost no money in marketing. They doubled down on the product. So I think, again, it just depends on how you come at it. It was something where the product just sells itself. The second one is a more interesting one. We invested in a company called Waze. And Waze was not well known in the US. And we found the company in Israel, we got them funding, and they were trying to figure out how to actually get awareness in the US. And traditionally, spending billboard money or spending TV money was really not the best way for the money they had gotten, because actually most of Silicon Valley had passed on them and when we invested. So they were very, very smart in sort of what I would call guerrilla marketing. They latched on to an event in LA, and for folks who are not from Southern California, the LA traffic is something that you will find 101 to be a piece of cake. You'll actually think you will never complain about 101 once you're in LA on 405. And what happened was there was a period of time when there was going to be construction on the 405, and basically there was panic across LA. People didn't know how they would get to work, and it was sort of, they thought the whole city was going to shut down. It was actually called Carmageddon. And that was the time when Waze, essentially, which was the best way to figure out traffic as user-generated, they sort of teamed up with radio channels across the county, paid nothing in actual marketing. The radio guys basically marketed Waze, and there was a step function in how user adoption happened with Waze. And they sort of used their marketing dollars basically to the best advantage. They always had the best product. So again, this is sort of a more coming to say that even when the times are good, I mean, some of these raise money when the times were fine, there is no reason to many times do billboard marketing if the product itself is good and it sells itself. So I think we will try to tell the entrepreneurs to make sure that basic item is done before you sort of go on kind of a marketing binge. Marketing can hide the product problems for only so long. At some point, it'll come about if the product is not good.
Thanks, Naraj. And Umesh, you have a very interesting background. You have been entrepreneur and investor and run a public company. So two questions for you. One, again on the same lines, any advice to this group in terms of how they should be intelligently using the capital? And secondly, which I'm more curious about, out of all those roles, which one did you enjoy the most?
So the first question, to add to Nagaraj, I agree with Nagaraj, but one of the things I always look for in an entrepreneur is the idea, is it a feature or is it disruptive? If it's a feature, it's going to get integrated into something. So I look for something disruptive. A problem, I call it, greater than 50% has not been solved. So someone comes with that idea, which I'm gravitated towards that. And then obviously the track record of a person, is this person a serial entrepreneur or not, or are they incredibly bright, so you after 5 meetings, you just feel like they're going to be the best team in that area to solve that problem. So that's the thesis for which I would add to. The second one is most companies become, after they have the initial product, spend too much on marketing and not efficient channels of marketing. For example, some companies spend 70% on marketing and sales and 30% on R&D. I think it's not a sustainable model unless you want to sell the company. I think you need R&D of 70% and find efficient channels. For example, in consumer, you can have virality. Your product better be viral to scale and put more into your product. In the case of enterprise, which is a little difficult to be viral, you need to have a right combination of outside sales, inside sales, productivity of each one of the sales channel. And I still feel anyone who spends more than 35% on sales, marketing, and others, and less than 60% or so in R&D, long-term is going to have a cliff because they can't keep up with the competition. So that's the first part of the question. Regards to my personal thing, I think there were two unique experiences. There are two stages of my life. The first 22 years were in operational running companies. The best part about that job was you were making all the decisions. So it was like an incredible amount of satisfaction when you won a big deal or got a product into market or won an amazing customer. So closer to the customer, making the decisions, not influencing it, were amazing times I had. The negative of it is running a public company, and I vowed since then not to run one, is the public scrutiny of every quarter you have to deliver. So you can't take a long-term view and say, okay, this is the inflection point, I'm going to go and address this, but short-term I'm going to suffer. You cannot. Either your employees are upset, or investors are upset, or customers are upset because your valuation goes down when you take that. So that's the part which was negative for me. Too much in the limelight, 24/7. On the private side, it's a completely different, I enjoy it as much. The best part is I'm now involved with 8 to 10 entrepreneurs and companies at any given time, versus a CEO, I was vertically deep focused into one area, digital video or whatever, but I wasn't broad. Here, it's a fascinating opportunity to work with 8 or 10 CEOs of the company who are brighter than me and learn from them. That's the excitement for me. Every day I wake up with a lot of excitement. The other thing which is negative of that job is I'm no longer with a customer. Because I'm not running a company, the interchange with Apple or some of the Facebooks or the Googles of the world, I don't get that. I get it through my CEOs. So that's the negative part of it. But I think both jobs are phenomenal. I think one thing you should take up is, are you an operational person, or are you an investor who love to be broad rather than deep? I think that's the question you need to ask yourself. And both are incredible jobs. It's what you make out of it.
Fantastic, thanks. And audience, we would love to take your questions. So I want to keep 2-3 minutes for a couple of questions. And before we do that, just a very quick question, Rajiv, to you and Neeraj, very, very quick one. So Rajiv, from your perspective, once the elections are over here in the US, do you expect more increased activity between US and India in 2017?
Well, I think even the current engagement is pretty good between the two governments. And as far as my fund is concerned, I do expect, because the Indian side is already forthcoming, they want to enhance our scale of operations by few orders of magnitude. And if the similar kind of commitment comes from the US government, I think we have a very straight road ahead. But then parallelly, it's always better not to depend totally on the governments. At times, governments can be unreliable. So we are also trying to explore other possibilities to beef up our corpus and create parallel streams of revenues, so that we can scale up our activities and we can increase both the depth as well as the breadth for what we do.